Hey, Damian Mason here with a question before we hop into this episode of the Business of Agriculture. If you farm for a living, you employ a lot of amazing technology, from your inputs that you put into the soil to the tractor that you sit in, your combine, and the amazing data that it harvests. But has your soil analytics kept up technologically with everything else in your farming operation? I would venture to say that no, it is not. Sure, you check for your nitrogen, your phosphorus, your potassium, your micronutrients as well. But what about disease pressure? Do you know what diseases and what pests you're going to face next year? No, you don't. But you can now figure that out with Pattern Ag's predictive analytics. Think about it. They can tell you now with testing what the likelihood of facing nasty diseases, things like cyst nematode or sudden death syndrome, what the likelihood of you having this in your field. Then you know how to prepare, how to treat, and where to invest your money. It's using technology to make you bigger yields and therefore make you bigger money. Go to www.pattern.ag to learn more. They are pioneering the way in predictive agronomy. Well, hey there. Thanks for being with me and my guest on this episode of the Business of Agriculture podcast. Got a great topic for you today. We're talking about money. We're talking about private equity focused on funding agriculture. Okay, here's the deal. This is not a Wall Street oriented podcast. You know that, but we do talk about money because it is the business of agriculture, and business is about money. You know, we don't shy away from that. So I thought, why not bring in somebody who's actually actively investing in the space known as agriculture, and specifically in rural America. His name is Jim Schultz. He is the founder and CEO of Open Prairie Management. I was introduced to Mr. Schultz this last summer. A good friend of mine, my college roommate, is at this point in his life sold his business and does some investing. He was in on a session where Mr. Schultz was a presenter, and he said, "Hey, I want you guys to meet." So that's how we met. They're in Effingham, Illinois, of all places. No, they're not out in the Silicon Valley. No, they're not in New York. They're in Effingham, Illinois. And they take money from investors and deploy it into rural America, into agricultural ventures. They don't do first stage, meaning if you've got this idea where you're going to plant corn on the moon, they're probably not going to be your investor. He's going to explain where they put their money, the benefits they see of putting money into agriculture, what their investors are looking for when they talk about return, and the kind of projects they're doing. Because obviously, Mr. Schultz might be biased since he's the CEO, but he says, I think this is kind of an optimistic place. I think there's some really good stuff happening out here in agriculture. So remember, if you're going to grow, if you're going to have expansion, you need money as the seed capital. And that's what we're talking about here. So, Mr. Schultz, thanks for being here.
My pleasure. Thank you, Damian, for having me.
Open Prairie. You contacted me this summer. We had a couple of calls. I liked it. I still think this is a great topic. And I'm like, would you come on my podcast? What does Open Prairie do?
So we're a private equity fund investing in agribusinesses that need growth stage capital. So sort of your earlier point, we don't invest in ideas. We invest in companies that have revenues, have at least profitability or line of sight to profitability, where we can put capital and help them grow either geographically or through new product expansion or through acquisition. So our capital is there to help build upon what already is a great business.
Yeah, and so you do some stuff that's not ag, but it is in the rural space. But let's stick with the ag stuff. So just to the person that, and I try to always start at the beginning. You know, we got people who are listening to this that own their company and they know all about Series A's and B's and all that stuff. And we got somebody that's in a machinery sales job, and I'm like, hey, we're not going to talk above your head because we're all about educating and giving you some insights here. You start with this idea. I want to have this thing called Open Prairie, but you came from what sort of background?
So, Damian, I grew up in the ag space. Our family had 3 operating divisions in agriculture. We had a proprietary seed business, a wholesale chemical distribution business, and farming operations, both in the Midwest and in Brazil. So as a child, I was active, driving tractors. I lived for a while in Brazil and our farming operations there, but grew up in and around agriculture. When we sold the family seed business, I got into private equity with some of my own capital and some friends' money, and quickly realized there was a need for more capital. And so we put our first fund together in '99. And so we've been in the business just short of 25 years. Initially, we were focused on just general opportunities, but fairly quickly on, we realized that we had a unique niche and opportunity. And back in '06, we started to focus exclusively agribusiness investments.
Yeah. So you put your fund together, and this is interesting. So you were sitting there, you had some money, and you had some associates. We get to a certain point in our career where it's like, okay, I'm sitting on some capital, you're sitting on some capital. We ought to deploy this for some returns, whatever. And then what? You said there's bigger opportunities, there's bigger fish to fry than my capital can stomach. And so then you said, let's go and raise another couple $1 million from some investors and put into this. Is that kind of how it came together?
Exactly. So back before the 2000s, I was putting deals together by myself, putting in $500,000 to $1 million, raising $5 million. That might take 8 to 12 months to do all of that. And a lot of opportunities slipped past us. So we decided with an active fund of $40 million, we could more proactively and quicker act upon opportunities. So that was the genesis and what caused us to raise our first fund in 99.
You started this fund in 1999. And was it easy to raise money, or did you go to skeptical people with capital and say, we've got this idea. We're going to go to little towns you've never heard of. We're going to go to Geneseo, Illinois, and there's a company there that cleans grain and puts it in bags. And they'd be like, and you're talking to some Chicago people, said, what in the hell are you talking about? Is that how it was like? Or did money come pouring in?
No, in no way did it. It took us 2.5 years to raise the fund. But being the sixth of 8 kids, I learned to be persistent in life. And so we continued to knock on doors, got turned down over and over again. But ultimately, we were able to put together, through friends and family, a $40 million fund.
You put together a $40 million fund, and it wasn't for one specific project. So you went and banged on these doors. You said, listen, I put money into deals. I've been doing this. Here's my portfolio. I've done this for the last 5 years. I mean, I'm guessing this is how it went, right?
Yes.
You said, I invested in this seed company, or this guy and his wife were over here building, this aftermarket piece of equipment that goes on a implement, and I put some money into it. I mean, you got a story, but then you're kind of pitching them blue sky, right?
It's a blind pool. Yes, exactly. And so they didn't know exactly what we were going to invest in, but they knew that our thesis was to focus on opportunities in the region.
Yeah. So you banged on the door, and then what'd you promise them? Promise them, I'll try not to lose this. Give me a few $100,000. I'll try not to lose it.
So the standard in the industry and what we followed was we aspired to get a greater than 20% annual rate of return on the capital, or 20% IRR, internal rate of return. So that was the goal and objective. And you don't use all the money up front. So with the $40 million, we deployed that from 99 through 2004. So we drew it down as we needed it. So in effect, what we're trying to do is put the capital work over time into various companies and get the benefit also of I'll call it the cyclicality and not being in one cycle.
Yeah. And have you attained 20? Because right now, you got somebody here sitting on maybe they're sitting on a few $100,000, and it's getting them 0.3% interest. And they're saying 20% internal rate of return. Good God. How do I sign up? Tell me about the actual, what you've actually gotten?
Yeah, I think the reality is you have to look at it on a long-term horizon. It's not 20% year over year, cash on cash. Unlike a CD or some other investment one might invest in. So our first fund was all startup companies, 15 startup companies. Within 3 years, 5 of them failed, and so it was an early stage fund. Of the remaining 10, we had 2 IPOs and ultimately got to just short of 2 times our money and about a 9% IRR. It took us 18 years to get to liquidity, and that's why we pivoted in 2006 toward growth stage and opportunities that were later in nature. All the companies, again, in the first fund had no revenues when we invested. The funds today that we invest are companies that typically have $5 million of revenue and are either profitable or about to be profitable.
All right. So that brings us to today. You gave us the background about starting up, and then after you went and leaned on every person you knew, you banged on everybody. Were you like the Amway salesperson at the dinner table? You get invited over to your relatives for a birthday party for their kid, and you're banging on them for money. You weren't that person, were you?
Did you call my sister before this interview? It felt like it sometimes, yes.
Now you have this money, and you also have a track record. So presumably money comes in a little easier. Friends like my friend that was thinking of deploying some money into investments with your group. You're not into doing the hard raising anymore. Is that what I'm understanding?
It's still a challenge, but we have a pretty good stable of investors, both family offices and commercial banks that are financial institutions that have followed us. And so that makes it a little bit easier to get re-ups when you have existing investors prepared to follow in the next fund.
Mm-hmm. All right. So what does it look like now? Here we are 24 years into this. What are you doing? Give me some success stories. And if you're going to be honest, you better give me an implosion failure story also.
The industry is marked with a lot of experiences with the implosions, but some of the successes we've had have included in our first fund. I mentioned we had 2 IPOs out of 2 startups. In one case, the founder came to us with an idea in his notebook, and he didn't even have a company, and we helped him get it set up and took that company public on the New York Stock Exchange in 2012. IPO valuation was just over $1 billion. We had about $4 million invested and took $50 million off the table on that investment. That was not in the ag space. That was in the data security space. Again, that was a different fund than what we're doing today.
You still have an investment in it? Did you take everything out, or you just took out?
We took it all off the table. Again, my money, it's not my money, it's my investors' money. So I need to return that capital to them. So when we have the opportunity to liquidate a position, we take advantage of that. The other success I'll point to is one in our current portfolio, a company called Shenandoah Valley Organics. Farmer Focus is their brand. It's an organic poultry production operation. When we invested, they were doing revenues of under 100 million. Today, they're about 3x that. And with the capital that we put into the company and with the great management team at Shenandoah Valley Organics, we've seen explosive growth, and we see great opportunity for them to continue to grow into new markets as they move west toward the Mississippi.
Let's use them as a case study here, if you will, because I think that's a really good illustration. Because like I said, there are people that are brilliant, they're smart, they're successful in this business, but we're getting them kind of a behind the scenes peek because they hear about venture capital, they hear about private equity, they hear about, hedge funds, but they're not exactly sure how it all works. So that's why I want to get into that. Before we do, I want to remind my dear listeners here about Truterra. Truterra is a company that I've begun working with here, and they're focused on supporting farmers at every stage of their sustainability journey to help them plan, make, and maintain regenerative management practices that will improve the agronomic, economic, and environmental sustainability of the farming operation for the long term. You can find the right program for your fields at truterraag.com/enroll. I did a recording with them, dear listener. Mariah Murphy, if you want to go back and listen to it, where she explains very succinctly how this thing works. We're talking about carbon credits. We're talking about removing nitrogen. They've got a new pilot program for that, removing of nitrous and nitrogen out of the atmosphere, and you can get paid. Companies give them money to then appeal to their shareholders and to the customers by saying, hey, we are putting our money where our mouth is. We're putting money into carbon sequestration, and we can give you money as a farmer to help us in that endeavor. So check out truterraag.com. All right. Shenandoah Valley, Jim Schultz, is a good example. They are what? Organic poultry products.
Yes.
But you said when you came in contact with them, they had $100 million of revenue. Why did they need you?
They were short of 100 million when we invested. They needed capital to expand into additional markets geographically and to expand and build their plant out further. They did not have a cold processing facility, so some of our capital went to the expansion for the plant and also the geographic expansion.
Okay, so they had, but you said you don't do startups, meaning if I just come to you and say, I've got this idea, I want to plant corn on the moon, you're going to say, hey, that's cool, but we're not your funding. Shenandoah came to you and said, we sell chicken. We sell organic chicken. We get better premiums than the big boys that just sell commodity grade chicken, right? And then and then you said, good for you, but what do you need us for? And then how'd it go?
So I think they wanted capital, first of all, but secondly, they wanted some capital that could be smart capital that could add value to their business model. And so some of our background with our team, I've got 8 partners in our fund. Collectively, we have over 250 years of experience in the food and ag space. And that's a real competitive advantage for Open Prairie. So they wanted access to some of our expertise and some of our network as they look to grow their business.
Yeah, so you offer more than just money. It's not passive. Your investment in this is not passive. You're actually assisting along with managerial, or maybe not day to day, but long term strategic.
Much more strategic. We don't want to be involved day to day. We don't think that's a good role for us. If we have to, we'll roll up our sleeves, and we've done that from time to time. But we're investing in a management team, much like real estate. It's location, location, location. In private equity, it's management, management, management. We want to back great teams, help them execute, be strategic in nature, and help them grow their business by the networks that we have in our business backgrounds.
So you put this thing, they came to you.
Correct.
Okay, now I'm going to ask the other question that I'm sure somebody's asking. Why did they not go to a bank? Why did they not go to Farm Credit Services? Why did they not go to the local agricultural institution in wherever their headquarters is?
Like many companies that we meet with, their balance sheet can't support additional debt. They don't have perhaps enough equity on their balance sheet. And so we'll come in either with a mezzanine debt piece, which means we're below the bank in the capital stack or on the balance sheet, or we'll come in with equity. In the case of Shenandoah Valley, we came in with equity because they needed more equity on the balance sheet.
Okay. And to the person that's not well-versed, that you speak in the vernacular of an investment private equity group, the person that's not well-versed, mezzanine means?
Mezzanine means it's below the senior bank lender, but before the equity. So if there is a situation where there's a liquidation of the business, the senior lender will be paid out first.
The bank.
The mezzanine debt would be second, and then the equity holders third.
Okay. So you're in between equity holders, meaning somebody that says, I have 10% ownership in this company. You're going to get your money before them, but you're not going to get your money before the bank if there's a default or there's a problem.
Correct.
Got it. And then you used another term. What the heck was it right there? I want to make sure we backed up. Okay. I forgot.
Capital stack.
There you go. Capital stack.
Yeah, capital stack's just basically the same thing. Balance sheet, the senior debt, mezzanine debt, then the equity is the way you stack the capital, so to speak.
You said you came in and you gave them what is it? You said you came in and they were in a situation where they were selling poultry. So they had cash flow and they had customers. And so were they losing money, or were they just what was their situation then?
They were a profitable business, but their ability to scale from a 20% compound annual growth rate to a 40% growth rate would not be achievable without additional equity. And so we were able to provide that additional equity to allow them over a 3-year period to basically triple revenues.
And by doing that, did you just go in and just say, here's $10 million now, and then here's a chunk of money?
Well, it was after meeting with them, understanding their business plan, what their growth strategy was. We got comfortable with that and said, we're prepared to write a check along with some other investors that we brought in. So it was a process. And typically that process, Damian, takes anywhere from 90 to 120 days before we get from a decision to invest to where we put the money into a company.
Mm-hmm. So you gave them a chunk of money. Do you mind me asking how much?
We put in $3 million.
Okay. And did they go and build a barn, or did they leverage that $3 million and say, okay, we're going to leverage that $3 million. Now our bank, because you gave us 3, is going to give us 10.
Correct. It wasn't that big a number, but the bank did come in and provide a larger senior piece and also provided a term debt facility to build out the cold processing plant.
Yeah. So then they were able to create more infrastructure because of that. Right. And so you were looking then at what this thing could grow into. Was there any hesitation? Or if there was, what was the hesitation?
You always have hesitation. Any deal you do, if you don't, you're probably not looking at it right. But yeah, I think the hesitation was from a macro perspective. Would the trend of organic poultry purchases at the retail level continue? Will the consumer continue to buy that product? We think certainly they will, and we believe will continue to. I think secondly, could the management team execute and grow the business to the scale that they thought they could? They've proven that to be the case as well. And I think third, we always look at, will there be more capital needed? Do we have enough reserve for that need if the company has a need for more capital?
Well, that's the thing, because, okay, you're going to Las Vegas, and there's that thing of, all right, I put down my $100 bill on red and then it hit. Boom, take your money and leave. And you can't do that in this situation because they grew. You gave them a $3 million infusion of equity. Could you yank your money out like as soon as the roulette wheel hits red? Not really. You're in this for a while.
Yeah, we're a long-term investor. We typically look at a 4 to 5 year hold on our investments. Some of them are going to be longer than that. Just depends upon the situation. In almost all cases, what we structure is a right to put our stock back to the company within year 5, so that if the company's achieving some milestones and we want to get out, we have an ability to force a liquidity event. We've had that happen in one case in the history of the business. The company was unable to come up with the cash to buy us out. It took them another 8 years to get to a level where they had enough cash to buy us out. But it did give us the club, I'll call it, to be able to execute or exit out of the business at some point in the future. Again, to be real clear, I get the money from our investors over a 10-year life. So they want me to put the money to work in 5 years and be out of everything within 10 years. So I've got an unfortunate situation in this fund structure business that I can't be in these things for 15 or 20 years.
Yeah. So like in the case of Shenandoah Valley, you put in $3 million and you told your investors, we're going to be in here for a while. And then the idea is that at some point they want to just take their return and move on. When that happens, Shenandoah, you say, is going to be large enough or have enough capital on their own that they can just pay you back your principal plus the gain, right?
Correct. That's right.
And then is there an interest in you said we're the long term. Is there something like this where you'd say, we're going to stay with you for the long haul? We want to double down. We want to give you another 3 million or another 6 million because we think you can even do bigger things.
Well, we actually did that at the end of the year. I stated we did 3 million. We actually did another 2 million at the end of the year because of what's happening with the growth of the business. There was an opportunity for them to expand some of their geographic footprint. And so we, along with other investors, put more money in late 2022. So yes, we do that. However, more specifically, Damian, to your question, we want to be in these investments 4 to 5 years, maybe 6 or 7 at the longest period, only because we have to return capital to our investors. If we don't return capital, it's hard to raise the next fund.
So there's the next question. So the person listening to this right now that says, hey, I've got some money laying around. Now there's somebody listening to this that says, oh, wait, they're talking about people that have $1 million to toss into this. Or there's somebody driving down the road saying, well, I've got $5,000 to put in. You have minimums and you have terms. Tell me how, if I want to be an investor. Now, remembering that we're not at your aunt's bar mitzvah where you came and banged on me. Now you're in a little better situation. You have investors looking at you and wanting to deploy capital. And by the way, there's also a lot of capital floating around right now. There's a lot of people with money right now. I mean, the Federal Reserve is trying to make it so it's not that way, but there's a lot of money floating around. So there's money floating around. The person that comes to you, what do you tell them?
So a lot of questions there, but
I know a lot of questions. You're going to answer them all.
I think from a macro perspective, you and I have talked about this. I think we're in a super cycle, and with what's happening globally, I think U.S. agriculture and food is a great opportunity to invest. That's from a macro. From a more detail to your question about minimums, there's two answers to that. One is we try to get to $1 million minimum commitment, and keep in mind that's funded over roughly a 6-year period. As we need the capital, we put it into companies. It acts like a line of credit. I don't sit around on idle cash. So the investor in my example, if they committed $1 million, would anticipate, roughly, $175,000 a year that we draw down in quarterly amounts as we make investments. Secondly, to the question,
so does that person write a check to you for 175 every 12 months or half of that every 6 months?
It's done quarterly. So, roughly call it, 35,000 a quarter we draw down as we need it. But the second answer is that if it's somebody strategic that could be very beneficial to our business and maybe be a grower that could help us do some test plots or somebody that could help us get into new channels. Like I have some co-op investors who are in a fund. They've come in for much less than that, only because we see them as being important strategic partners. As we invest in businesses, we want to grow those businesses. And the ways we can do that is by field trial opportunities, by ag retail exposure to agronomists, things like that are maybe more important than just the actual dollar amount of commitment.
Yeah. So, yeah, it's kind of the old thing of, remember, George W. Bush was allegedly an investor in the Houston Astros, I think it was, a baseball team. He really wasn't. He just brought a name so he could help him get a stadium deal, and they gave him equity. But anyway, that's a different story. So you're saying that if somebody brought you the George W. Bush package of I can get you a new stadium built, you might let them in for much less than $1 million.
We'd love to have the conversation. Again, I've got some strategic investors that we specifically allowed them to come in for less than that amount because we saw value add. And it's really about the partnership. We're not just looking for dollars. Yeah. We're really looking for partners. And we have farm credit system banks, for example, that are partners, investors in our fund. I have several commercial banks. We have some of the top ag lending banks in the country that are investors in our fund. And we look to them to be helpful as we grow these businesses and open up their networks. In some cases, they're the senior lender on some of our portfolio companies. So it's really about finding great partners, not just about finding money.
So they give you this money and you tell them, hey, we're going to take $35,000 a month from you on a draw for the next 6 years. And then they say, great, what am I getting in return? And then you say, well, we're going to shoot for X return. And then they say, when do I get it? And then you tell them.
So two answers. One is we invest in mezzanine debt, like I mentioned earlier, and that has typically a current coupon on it, meaning that we get an interest payment each quarter from the portfolio company. On average, that's about 4% per year to our investors. In addition to the return aspect, the long-term return, we would anticipate that it would take us 6 to 8 years to start to generate significant returns from the capital we put to work in year one, keeping in mind that we're going to be investing in year 1 through year 5. So it's going to be stretched out over a long period of time. The year 5 investment, we would aspire to have exited out of by year 10 of the investment cycle.
Yeah. So what I'm also thinking here on that regard is they're getting return along the way, and they're obviously getting the bump on when the thing matures. Do you set the terms, or can I, as an investor, say, well, wait a minute, I want to do this. I want to stay in Shenandoah Valley, or I want out sooner. How's that work?
Yeah, that's a great issue we face. We don't have the luxury of saying, well, I'm going to take care of Damian different than I'm going to take care of Jane Doe. Our attitude has always been, you provided us cash to make this investment. We have an obligation to return cash back to you. We've had cases where we had publicly traded stock and had the option to distribute that stock to our investors. Yeah. In polling our investors, 90% of them said, I'd rather have cash than stock. So we have to be a little bit dictatorial and just say, here's how it's going to be. And that's typically what we've done.
Mm-hmm. The capital thing that when I asked you 12 questions in one question, you said there's a lot of questions there. There's a lot of money floating around. And it seems to me it might be drying up a little bit. I don't know. But I can tell you that it looked to me that sometime, and we're recording this, dear listener, in the first quarter of 2023. Okay. So if you're listening to this like in 2025, who the hell knows what's going to happen? But I can tell you that when I'm looking the last few years, it looked like there was money a lot of places, a lot of capital looking for a home. Am I right? Was there a lot of money floating around? Is there still a lot of money floating around looking for somewhere to invest?
I think there was, and I think there still is. I think it's a little bit less so. We have some family office investors. These are people that made their wealth in the oil business or in the telecom business, and the family now is 5th generation or whatever, and they may be sitting on a couple $2 billion. But they got hit last year like everybody did. And if they were in the S&P, they're down 18% or 20%. And their $2 billion now is only worth $1.6 billion, and they feel poor. So there's a psychological aspect to a lot of money being around as well. I think the short answer is yes, there's a lot of money. I think it's just making the compelling case that where do you allocate that money? And of course, as I said earlier, we think food and ag for the next decade is a place to be an investor.
I think for the record here, if someone listening is saying, wait a minute, is Damian got this guy on because he's one of those guys that went from 2 billion down to 1.6? When we talk about family office for us was a filing cabinet next to the deep freeze and a very labor intensive, capital unintensive dairy operation where we worked like peasants. So my family office is not the one he was talking about. But also, those aren't necessarily your investors. You don't have a lot of the 1.6s, I'm guessing, do you?
We have a handful of family offices that invest with us, yes. And
what's your more common? And that's a great example. Like, is your more common investor somebody that's worth 5 million and wants to put a little money to work, 10 million? I mean, give me a profile of what you think your typical Open Prairie investors.
We have three kind of different levels of investor. We have institutional investors, so those are commercial banks, farm credit system banks. We have family offices that have over $1 billion in the family office. And then we have high net worth individuals that are investors. They typically have net worths of over 5 million, but not in all cases. We don't know for certain, but they have to be accredited, of course, to meet the SEC guidelines. But typically they're physicians or business owners that have probably more than $500,000 a year of current income and have an ability to fund a commitment like we're talking about earlier on.
Right. Regulatory. Because there's somebody listening right now that says, "Hey, wait a minute, man. What guarantees do I have?" There's no guarantees, right?
There's no guarantees. It's risk capital. We also though recognize that, and what we have structured within our fund, and this is per what we put in our regulatory filings. We don't guarantee. We provide an 8% preferred return, meaning that we will return all the capital plus 8% annualized on the capital that the investors put in before we share in any profits. Mm-hmm. And that's, I think, a distinction that's important. The way that I make money long term is by generating great returns on the capital we put to work. So if I put 200 million to work and I make that into 500 million, that 300 million of profit, we share 80% to the investor, 20% to us as the fund managers. So we're incentivized to get to that level, Damian. But before that, I still have to get that 8% preferred return in my example.
Yeah, you've got to make them their 8%, and you're profiting off of their money, but you're doing the work.
Correct. That's correct.
Yeah. And I think, and I always talk about old farmer mentality. My parents suffered from it. Well, give that guy, he's just going to make money off this. Like, I'd rather make 80% of a huge return than 100% of no return. So I'm all for that. What about the space of agriculture where we talk about the capital's going into it, biologicals, and I'm sure you've been approached. Good God Almighty, this started. I don't know. I started seeing it 3 to 5 years ago, and it probably was before that. But when I started really seeing it, everybody and their sister has tech money or Silicon Valley money or somebody's money, and they've got this product, and here's this thing. And I'm like, what the hell? I never heard it. It just was a proliferation. Did you see that? Or is this something that I'm seeing and nobody else is?
No, I think we've seen a large increase in that space in the last 5 years. We fortunately invested in 2 companies in 2010 in our last fund that are in the space. One is called Vestron. It's a peptide technology that sells into specialty crops and also is now moving into row crops this year. But it has no impact on beneficial insects or beneficial pests, rabbits, rats, et cetera. And then another company we invested in 2011 called New Leaf Symbiotics, which is taking methylotropes and creating an ability to have a faster growth of crops, less need for herbicides, fungicides.
I got to say, I don't even know what a mesotrope is. It sounds like I'm a misanthrope. That means I hate people. But what the hell's a mesotrope?
Methylotropes. So it's basically the bacteria that the plant expresses on its own. So this technology helps the plant express more methylotropes. The more methylotropes on the plant means the less water the plant needs, the less fungicides, herbicides, insecticides. Yep. It makes it a healthier plant with higher yield. And we've had great results. We're doing a lot of things with Bayer in the traditional crops. We're doing some stuff in the rice area with some carbon sequestration. I don't know if you know, but rice is globally considered to be emitting 15% of the methane into the environment today. And there's a big push to try to reduce that methane emission at the rice field. So we're working with rice growers to do that right now.
Yeah, I did not know that. And what's interesting is the stats I read, the United States produces some ungodly thing like only 1% of the globe's rice, or 3%. We're a low single digit producer of rice. It's grown in about 6 of our states. Arkansas, I think, is the number 1. But when you think about, it's the staple food for, a few billion people over in Asia and in parts of Africa, there's a lot of rice produced. So what you're talking about is, if we can reduce the environmental negative of rice, it won't matter so much here because we don't grow much of the world's rice,
Right.
but it does other places. So you're in on these 2 companies, Mr. Schultz. They're in that biological space. There's still a lot of players out there. So the capital came into those companies thinking this is tomorrow. This is the future, right?
Correct.
And then I assume some of them say, we're going to make our money when Bayer buys us.
That's the goal, is to have an M&A type of opportunity, or potentially an IPO.
Yeah.
We think that that's also likely a financial exit path for us.
Yeah. So it's either you get bought in a merger and acquisition, or you do an initial public offering and become, New Leaf becomes its own thing, publicly traded, of course. All right, let's be honest here. Agriculture, the future. You're in this space. You're bought into it. What do we got to look forward to?
Well, I think from a geopolitical perspective, and the breadbasket of the world is here. I look at just so many challenges around the globe right now. Forget about Ukraine and what's happening in the Black Sea region. Look at what happened in Brazil with the earlier this month with the new president put in, and then this week he announced he's going to take and change all the board, or the control and executive leadership at the state-owned companies.
Yeah.
They're on a path to communism, and I think that creates additional capitalist opportunities for places like the U.S. Secondly, I think with the global food issues, I mean, we have 3 million children a year die of starvation. We have to find better solutions. We need to work more intently to develop new crops and new opportunities, like for places like Ethiopia and Kenya, Somalia. GMO is a great solution for that, and I think that it's incumbent upon us, with leading technology, leading research universities, to continue to develop those. From an investor perspective, there's all kinds of different things out there in the world, from crypto to EVs and new technologies. Food doesn't go away. Food continues to be the need, much like our parents said. They don't make any more land, and much the same way, the need for food and the need to produce more for the population is going to become more pressing for this.
I talk a lot about that. I'm not sure that whether we keep producing more of it in Illinois, it still maybe doesn't help Ethiopia. And I mean, that's a matter of distribution and economics. So there's going to be that concern. But you're right about the Brazil situation. If we are an export country, which we are, Brazil is on a path to beyond socialism. And a lot of people aren't seeing that. And obviously the media seems to be masking for it, because the last articles I read talked about how terrible it was that there was uprisings against this. And I'm like, they're uprising against what they see coming, which is the next Venezuela. And you could argue that Argentina, number 3 producer of soybeans in the world, Argentina is maybe already fallen off the deep end of this path toward communism light.
Yes, agreed.
Answer me this, a couple more on the way out the door, because this is a good conversation. We talk about money here on this episode of the Business of Agriculture. Jim Schultz, Open Prairie Management. The space you occupy, other than that biologicals, it's still kind of underplayed in. Like, you're playing in a sandbox that it's almost scoffed at, other than biologicals, because they had the environmental, the green crusade. The Silicon Valley money wanted to be in some sort of biological that you put in the ground, and it meant that you didn't have to ever use chemicals. That's not really true, but that's kind of what their thought was. But they don't want to do hog processing. They don't want to do Shenandoah Valley poultry, right? I mean, you're kind of in a sandbox that most of the big money scoffs at.
Yep, we've invested in a couple seed companies. We've invested in an animal health company. So yeah, we're doing, I'll call it the bread and butter of agriculture, where we're producing things that have real impact at the farm or at the ranch level. And some of the technology coming out of Silicon Valley I identify as they've created a solution for a problem they haven't identified. And they haven't talked to a farmer or to a grower or a rancher. They just think, oh, we've got this neat widget and we know how to do it, and you're going to accept it because we're really smart. It doesn't work that way on Main Street or in rural America.
That's probably the highlight. Dear listener, rewind and play that one again right there. Invented, was it the big money, the big tech people, again, they just think they're such goddamn geniuses. They invented something there was actually no demand for and said, we're brilliant. Just tell us we're brilliant and buy our stuff. And you summed that up brilliantly, speaking of which. All right, admit this. Everybody, you got to be honest here. Give me an example of a turd, something that you said, hey, I really think this is a place to go, and it didn't work out. On the way out the door here, let's admit, because we all know I always say this, Jim, I've been to 1,000 field days in my work, and they never drive you by and say, this variety by this seed company is the biggest turd. It's going to grow you 47-pound test weight. We know, and everybody else out here saying, we get you 60-pound test weight corn, 260 bushel yield dry land. Oh, this one is 47-pound test weight, 60 bushels. It's terrible. You know what? Nobody ever does that. They always show you their gleaming stars, and they take the bush hog out and mow off the other stuff. Don't be a field day. Tell me the truth. Tell me about a turd, and then also the lesson from the turd.
So I told you in our first fund, we had 15 companies. 5 of them failed within 3 years. Failed, went out of business. I got no dollars back. But more specifically,
it puts a lot of pressure on the other 10, right? The other 10,
yeah,
it's like,
absolutely,
holy crap, you other 10 better come along.
Big time. But specifically, we invested in a company in the food ingredient space. Great technology, great adoption, great growth curve, great management team. They couldn't get the gross margin to a level where it was at an investable capital level. We were trying to raise a third round of financing, and the investors all said, we just don't have confidence you can get this thing to a gross margin that makes enough money. And so we ended up closing the company down. We ended up, in that case, getting about 50 cents on the dollar back on our investment. Not ideal, but that's the business we're in. We're going to have some capital loss risk. But we also have some companies in our portfolio now that are, on 4 to 5 times multiple of what we invested valuation. So you balance it out on a portfolio perspective versus an investor saying, oh, I'm going to pick the right idea. That's really hard to do. I look at over 1,000 companies a year, and I invested about 4 or 5 companies per year. So to just frame that, we're doing much more culling. And so an individual investor might be lucky and pick the right one. By a portfolio diversification strategy, you'll hopefully avoid having a lot of turds.
Yeah, that's the fun part. What you just said right there is you look at 1,000 potential deals, and you put money into less than half a dozen of them.
Yes,
and even then, one of them's going to be a turd.
There will be some. You hope to avoid them.
But you know what? An old community banker told me a long time ago when I was speaking at a bankers conference about some failure rates, and he said, if you'd ever made a bad loan in this business, you missed out on a lot of good ones. And that's kind of the thing. If Mickey Mantle led the major leagues in home runs one year, but he also led the major leagues in strikeouts. I don't know. I wasn't alive in the 1950s, but that's what I'm told. Your name is Jim Schultz. The company is Open Prairie Management. Right now, somebody listen to this. They've either got a company or they've got money. Which one do you want me to? Who needs to call you? The person with the company, or the person that needs money, or the person that has money to invest?
All of the above. I mean, even if it's a startup company, I still like to get to know them and get to know what they're doing, so I can follow them. So to your question, we're still looking for new investors for our new fund, of course. And any company that we look at, we start to follow and file information away. So all of the above. My email is Jim at Open Prairie.
But wait, you don't want to be the startup money. You're not going to be, if they're talking about planting corn on the moon, it's like, good for you, but I can't be there. But talk to me in a couple of years when planting corn on the moon looks like you now have revenue and a customer base, and you need to take it to the next level, then we'll come in. Is that the idea?
And let me invest some intellectual capital into your company now and help you think through this. And after you get to the maturity level where I can put money to work, then I'm first in line, hopefully, to be able to make that capital investment when you're ready for our capital.
So you need everybody. You need somebody that's got a company. You need somebody, you want them to get a hold of you, and you have somebody that says, I've got money to deploy. And you gave me the rough numbers are $1 million minimum and 5 million plus net worth, so that they're accredited through and that's not your rule necessarily.
Right. Those are just general guidelines from SEC.
Yeah.
The other thing, if people want more information, they can email me at jim@openprairie.com.
And the company website is
openprairie.com.
openprairie.com. His name is Jim Schultz, CEO of Open Prairie. And you know what? It's a good discussion. We're talking about money. We're talking about money that grows. Remember, it's kind of like money's like water. Isn't that right? You need something to grow. Sometimes you got to put the money into it, not to mention the work ethic, the ideas, etc. But without some money, there's a lot of ideas that don't come to fruition. And that's the way it is. Thanks for being here, my friend.
Thank you, Damian. It's been a great conversation. I look forward to catching more of your podcasts. They're always entertaining.
Well, we keep it that way. That's why you're listening. So thanks for being here. Until next time, I'm Damian Mason, and this is The Business of Agriculture. Well, that concludes another fantastic episode of The Business of Agriculture. This episode was brought to you by Pattern Ag. You know, everybody in agriculture understands the importance of soil health. We also keep an eye on our soil better than we ever did through advanced soil testing. But what if there was a company that provided predictive analytics, not just checking out nutrients and all the elements that are in there, but also could tell you the degree of risk you face with disease and pest pressure? That's right. Pattern Ag can do that. They actually can tell you, hey, you're going to have a real issue here. You can proactively treat for corn rootworm or cyst nematode or sudden death syndrome before the problem actually starts costing you yield. Go to pattern.ag. That's www.pattern.ag to find the nearest rep that can help you start doing better for your soil.